Good afternoon, everyone. Welcome to our webinar for this afternoon. I just want to quickly go over some of the history of what we've already covered. You can, of course, go to the website and listen to all the previous webinars that I've done every Friday for the last 3 weeks. And what I want to just draw attention to is the things that we talked about. First of all, we started off speaking about the relationship between fundamental and technical analysis. Fundamental analysis being the search for the share's real value, and technical analysis being the study of patterns within the price and volume of a share in order to find something that we can use to help us to predict the future. And I spoke about how the relationship between those two is based on a discounted cash flow of future earnings and dividends derived from that particular share. If you're unclear on these things, like I said, go back and listen to the webinars of earlier weeks. And then obviously the discussion of where do these patterns come from. If there are patterns in the market, and I think I proved to your reasonable satisfaction that there are in fact patterns in the market, then where do they come from? And of course, how can we use them to predict the future, or how can we exploit them? That's really what we want to know. And I gave you the example of the moving average as a classical indicator which benefits from a particular human behavioral characteristic. It exploits a behavioral characteristic. And that characteristic is the fact that people generally have difficulty in adjusting their perception of the value of an asset quickly. And that tends to cause the market to move in broad sweeping trends. And to the extent that it does that, the moving average works. And of course, to the extent that it doesn't, to the extent that it moves sideways, the moving average does not work. But it is a very useful indicator, and it definitely does work over the long term. So that's the behavioral characteristic that is being exploited there. And when you look at any technical indicator, you need to try to understand why it works. What is the behavioral characteristic underlying it? Now, today, I want to give you a bit of a market update and cover some of the things that have been happening. But in the process, I also want to draw your attention to certain basic formations, which you can use to help you to pick up good buy and sell signals in the marketplace. So the first formation I really want to talk about is the trend line. And on the screen there, you see I've got a share. It's actually Ellie's. And here's the trend line, which I've highlighted in red. Now, a trend line is always placed above a falling trend and below a rising trend. And generally, the interpretation is that when the trend line is broken, that is the signal. So if it's a trend line, as this one is, above a falling trend, when it is broken, that would be a buy signal. So when the price of the share rises above the trend line, we say it's broken, and that gives you a buy signal. Now you'll notice that I've highlighted in blue the various touch points, what we could call touch points here. I'm just going to take off. So there's a touch point, there's a touch point, there's a touch point, and there's a touch point. So we've got 4 touch points on this trend line. The more touch points you have, the more reliable the trend line becomes as an indicator. I mean, you can just put a trend line on when you've got 2 touch points, but then obviously that's not very reliable. So when we started, we could have connected these 2 touch points here and extended the trend line down. And then when we found the 3rd touch point, we would feel more comfortable. It's become more reliable. And of course, the 4th touch point makes it very much more reliable. Some trend lines have multiple touch points, many touch points. And of course, that makes them long-term and extremely reliable. And probably the best example of that is the Rand. If we look at the Rand now, so I'm just going to switch over to the Rand here. The Rand to the dollar, the US dollar. Okay, I want to put a long-term chart on here. You can see here, well, let's put the long-term. I just want to show you this long-term trend line, which began way back here in 2002. sorry, in 2011. And we call this the Zuma line because it really is associated with Mr. Zuma's presidency. And as you can see, there are many, many touch points along this line over the years. Through 2013, 14, 15, many touch points there. And then finally, the Rand, of course, weakened sharply over here just before Nene was fired, but finally came back, and we had our last touch point over here. You can see it right there before. And of course, once it broke convincingly down through that trend line, we knew that a new strengthening channel was developing. You'll notice also something about trend lines, that the Rand came back up, and the trend line, which had previously been a supportive trend line underneath, became now a resistance line. So you can see the Rand bouncing off it, but on the underside now. So that's a common feature of trend lines. Once they are broken, you'll find that the share or currency or index or whatever, it comes back to the trend line, but from the other side. So what was support becomes resistance. Okay, so and of course now if we zoom in here, you can see that a channel is two trend lines. There's the upper trend line, upper channel line, and a lower channel line. And the important thing is that they are parallel. And here you can see the Rand oscillating between these two channel lines. Since Nene was fired, we entered, and Pravin Gordhan, of course, was appointed shortly thereafter. We entered a strengthening period in the Rand, and we've just recently tested that upper channel line. So if I go right out, you can just see, so I'm zooming right out, you can see how there's the ANC elective conference. This is where Cyril Ramaphosa was actually appointed. The Rand strengthened very well from there down to 11 Rand 50, but now it's come back up to that upper channel line, and it's been testing it. And it's strengthened quite a lot. It bounced off that channel line, and it's been strengthening since then. So that's where the Rand is. And of course, there are many factors which impact on the Rand. The Rand, well, let's go back a little bit and just say this. The currency of a country is like the shares of a company listed on the JSE. If the company is expected to be profitable and do well, then the shares will be strong relative to other shares, and vice versa. The same you could say about the currency of a country. If the country is expected to be stable and profitable, then the currency will be strong relative to the currencies of other countries. The more unstable it is, the less profitable it is, then the weaker its currency becomes. So if the country is generating trade surpluses all the time, exporting more than it imports, and therefore generating a trade surplus, then it's considered to be a profitable country, and its currency will strengthen. The same thing can be said about political stability and so forth. So a politically stable country has a much stronger currency. So the first world countries like England and America and Japan and so forth have very strong currencies. Emerging markets or emerging economies like South Africa and Turkey and Brazil and Argentina and Russia and China are regarded as less stable, politically less stable and economically less stable, because they haven't had as long to accumulate capital and build up their systems and their political stability. All right, so that's one big factor when considering the strength of a currency. Another one is, though, that the international investment community oscillates between being risk off and risk on. What do I mean by that? Well, when international investors are risk off, they take money out of emerging markets like South Africa, and they put it into safe assets like US Treasury bills, right? And that goes on all the time. So, but then they often oscillate to being risk on again, and because of course the return on a US Treasury bill is very low. If you look at our top benchmark government bond, which is the R186, that trades at a yield which is roughly 6% better than the US 10-year Treasury bill. So there's about a 6% benefit to being in South African government bonds rather than in US government bonds. But of course, then you have to take the political risk. So we have to offer 6% more, in other words, to attract those investors from overseas. But those investors overseas oscillate from being risk on to being risk off and back again. The recent trade war, which Donald Trump seems to be doing everything in his power to get going, has made international investors quite risk off. And the result of that is that they've withdrawn a lot of funds from South Africa. In May month, I know they took out 50 billion rand from South Africa, 30 billion from our bond market, 20 billion from our stock market, and obviously that money went into safer assets. However, the trend appears to be turning, and that is why the rand is starting to strengthen again, because obviously those overseas investors want to earn higher returns. And is the risk really so bad? So some of them start to buy back into South African assets like our bonds and our stocks, and that causes our rand to strengthen. So there are a few factors affecting the rand, and there you can see also a very nice example of a channel line and how the rand weakened to test that upper channel line. In fact, we were able to predict this. We predicted about a month ago that the rand in its new weakness here would eventually reach this upper channel line and bounce off it, and that's exactly what's happened. So the benefit of the trend line is that it enabled us to determine more or less how far the rand would go. We said about 13.75 to the US dollar. In fact, intraday it touched, I think, 13.99, but on a daily closing price base, we were not far out at 13.75. All right, so that's something on channel lines then. The next thing I want to just draw attention to is support and resistance. So to show you that, I'm going to go to Sasol. Sasol is interesting as well for other reasons, but here is a long-term chart of Sasol. And there's a few things that we can look at here. First of all, after the collapse of oil prices in the second half of 2014, you can see Sasol shares fell very heavily, and they fell from a high of about 650 Rand per share down to touch this low point down here at 360 Rand per share. Since then, they've touched that low on numerous occasions. You can see throughout this chart over the last 3 years, Sasol has come down to find that support at 360 again and again and again. So what that tells you is that clearly there are some big buyers for Sasol at 360 Rand. They had put in massive buy orders with their stockbrokers. Whenever the share reaches 360, just buy it. So whenever it came down there, it bounced off that level and moved back up again for a period of time. At the same time, there was clear resistance at the level of around 495, which is the upper trend line here. We call this a resistance line. And again, you can see that resistance was first established over here and repeated there and has recently, it was, if I zoom this out now, you can see that the share actually came back up, tested that resistance, fell back, and then now finally has broken through that resistance. So this is a clear buy signal on Sasol at about 495, and since then it's been moving up, but you can see now it's going to come back down and probably find this trend line, except now what was resistance will become support. So it should come back down to roughly 495, bounce off that level and continue on its way up. So there's a clear upside breakout from the channel that I've shown you here. You'll notice also here on the left another formation which is called a double top, right? Now double tops are very interesting formation. They're fairly common in the share market and in other markets, and they signify weakness. In other words, where you see a double top, you can usually expect that the share or index or currency or whatever it is going to fall back from that double top. So you can see Sasol was in a strong upward trend here, reached this high point over here at about 650 Rand per share, somewhere in that vicinity there, and then fell back, which is quite normal, quite understandable in a bull trend. The problem arose when it tried to go back up and break that high, to move back through that high. It failed. Now that failure is very significant if you're a technical analyst, because it then fell back on disappointment. So the fact that it failed to reach the same high as this earlier high was disappointing to investors, and they sold out of the share. And then you'll see after that, there's a huge sell-off coming down here. So if you were watching this closely, you would have observed this double top. And certainly the moment the share broke below this low point here in the middle between the two tops, that would be the final straw. But just the fact that it failed to penetrate that top there would have made you nervous, and maybe you would have sold out at that point. So you can see how just a simple observation of formations within technical analysis can help you to get out of the market at the right time so that you don't suffer from a major downward trend. And as you can see here, now we are saying that there's an upside breakout over here, and perhaps it's time to be getting back into Sasol. Obviously, that is stimulated by the rising oil price and other factors. Now, that's a double top, but let's have a look at a triple top, because you do sometimes get triple tops as well. So, okay. This here is what we call a declining triple top, because there's the original top at that level. Plenty of times there you can see individual candles that went up to that level and failed to penetrate it. And then there was disappointment. The share fell back. Of course, what I'm looking at here is Steinhoff. It then went back up again and tested those levels again, but didn't quite reach the same heights. So this top is lower than that top, right? And that's obviously a disturbing factor. So when it failed here, it fell back from that level, and then it made a third attempt to get through that high and failed again. So each one of these tops is lower than the previous one, but after the third top, there was a definite sell-off, and it never reached this level again. But if you were watching this and you saw this triple top, you would clearly want to get out of Sasol, out of Steinhoff. No doubt about it. And this, remember, this triple top happened 15 months before the Viceroy report was published. And if you were sensitive to it, well, you could have got 80 or 90 Rand per share. Remember, at the time that the Viceroy report was published, Steinhoff had fallen all the way down to 55 Rand a share. So observing this triple top would have saved you an absolute fortune. And obviously, some of our biggest institutional asset managers did not observe this triple top or thought it was not insignificant, and they lost a fortune as a result. I know for a fact that Coronation lost about 14 billion Rand through their investment in Steinhoff. I know the Public Investment Corporation lost about 18 billion. Altogether, the institutions lost about 200 billion Rand on Steinhoff. And our observation, or our suggestion, was that you simply go and, as a private investor, once this Viceroy report had been published, you see here how the share collapsed from about 55 Rand all the way down to 4.60 Rand or so. Just when you see something like that in a blue chip share, just put on a moving average. It should be a 65-day exponentially smooth moving average. So you go down here and you change it from simple to exponential, and you just say create, and there's your moving average. And what's interesting about this is that you can see here, this is what we call a bull trap, by the way. You can see the share seemed to have found a bottom and then rallied off that bottom. From about 4.60 Rand, it went up almost to 8.60 Rand. But then that's a bull trap. It was never, there was far more bad news still coming out about Steinhoff. And it's come out over February, March, April, May, June, all the way through here. We said just stay with this 65-day moving average, look for an upside breakout. And the share just trickled down, eventually reached a low point in June, I think, of 107 cents down here, if I'm not mistaken. Yes, there it is, 107 cents. That was on the 4th of June. Since then, it's been moving sideways, but recently it has started to move up. And this is because the directors at Steinhoff have managed to make some good deals with their creditors. persuading the creditors to give them time. They're looking for about 3 years so that they can restructure the company. And as you can see, yesterday, the share made a clear upside break through its 65-day exponentially smooth moving average. You'll also see that the moving average is now starting to move up. And here we've got the share at 3 Rand 19 this morning. So if you'd gone in there straight after seeing this upside breakout, you'd have already be in the money. It's at 3 Rand 22 already. So as we speak here, it's actually improving. So there you've got an example of a triple top and some advice on how to use the 65-day exponentially smooth moving average to take advantage of high quality blue chip shares that collapse. When they collapse, you just put on the 65-day exponentially smooth moving average and you wait patiently until you get that upside breakout, because that tells you, that gives time for all the bad news to come out. Everybody can adjust their perceptions. But now it looks like the share is on the upside again. It's moving up quite nicely and quite strongly. Okay, so that's Steinhoff. And then I just want to look at the what's happening in Wall Street, because that's also important. So let's take a look at that. You're very familiar with this chart because I generally look at it every time we talk. And here you can see how we had our record high, and then we fell down to this low point here at 2581 on that particular day there, which was the 8th of February in this year, 8th of February earlier this year. So that was the low point there. And that low point you'll see is at 2581. Then the index, this is the S&P 500, rallied off that and went up and found this upper resistance here at 2786. It then rallied again and found it again. You'll notice that 2786 is the height of this green candle, not these red candles, because they actually closed below that level. But this green candle actually closed on 2786. Then it fell back again, and this red candle here made a low again at exactly that figure, 2581. And that indicated to me quite clearly that we could draw in a support line at 2581. Since that low, the index, the S&P 500, entered an upward channel. And you can see I've drawn in channel lines, an upper and lower channel line, which have been supported by a number of touch points, making them more and more reliable. Notice how they are parallel. And obviously, if you're thinking about whether there's any foundation for technical analysis, the fact that they're parallel has got to be significant. I mean, what is the statistical probability of having touch points on the upside and the downside which yield you two parallel channel lines? So here we go, and it came down here, found this lower channel line on a couple of occasions, and now it's rallied off that. But the important thing is, it reached that resistance level at 2786, fell back from it, found the support on the lower channel line, and it has now gone up and broken that resistance at 2786, and it closed last night at 2798. So it's clearly through that level, or it looks like it's through that level, but it's still within this upward channel, you see, which gave us the clue that it would actually break resistance here. And we actually spoke about that last week and even the week before when we were talking about that. So that shows you how we're using support and resistance lines and channel lines to give us a nice technical indication of where things are going. Now, before we leave this chart, I just want to draw your attention to one other thing here. You see this area from here. Oh dear, sorry, I picked up the trend line by mistake. I'm going to put it lower then. Okay, so I'm just going to put a line in here to show you something. Okay, and I'm going to pick that line up and move it up underneath here. That area which I've identified there is what we call an island. And you very often get an island formation at the bottom of a downward trend. So then the share or index comes down, then it moves sideways, it backs and fills for a period of time. And that forms what we call an island. When there is an upside break out of that island, you often get breakaway gaps. Here's a classical breakaway gap there. Do you see that gap? And that shows that there's strength. So you've had a sideways period, and now you've got strength leading to a breakaway gap, and that shows you that the market is very strong, and that penetration of this upper resistance at 27.86 is highly likely. It's likely also because of the upward sloping channel, but the island gave you a very good indication that that resistance would be broken. Now, of course, what we are all waiting for is for the S&P 500 to break above this record high over here at 2872. Remember that it having broken up through the resistance line, it will probably go up a little bit and then come back to the resistance line, which will then become a new support line, as I've shown you in other examples that we've dealt with today. So, folks, that's kind of what I had for you today. I'm sorry it's been quite protracted and quite theoretical, but I have tried to put in a bit of current market events and trends at the same time to make it more topical and more interesting. If you didn't understand everything that I said, I suggest that you go back and listen to the last 3 webinars before this one, and then I think it will make more sense, because you'll have more of the background to why I'm talking about these formations. The stock market is not random. You can see that quite clearly from what I've demonstrated to you today. So if it's not random, it must contain patterns, and it merely remains for us to find the mathematical tools like trend lines and support lines and channels and islands and so on that will help us to use those patterns to predict the future. Thank you for listening to me today.